Something very strange is happening in the silver market right now, and almost no one is talking about it. Silver is disappearing, not from price charts, but from the real world. Governments are buying, supplies are tightening, and retail investors are being pushed out quietly. If you think this is just another commodity cycle, you're about to miss something much bigger. Stay with me, because by the end of this video, you'll see why silver shortages always appear before financial stress, not after. So, what's actually happening here? To understand this, you need to know there are two types of silver: physical silver and paper silver. Physical silver is the actual metal, the bars, the coins, the industrial-grade silver sitting in vaults. Paper silver, on the other hand, is a financial contract, a promise to deliver silver that often just gets traded back and forth without any metal ever changing hands. And right now, these two markets are telling completely different stories. The paper price says one thing, but availability says another. We're seeing headlines about falling inventories at major exchanges like the COMEX and the London Bullion Market Association. These are the warehouses that back the global financial system. The stockpiles are being drained, and it's happening at an alarming rate. It is like looking at a fuel gauge dropping steadily while the price at the pump stays strangely calm. This disconnect between the paper price and the shrinking physical supply is the core of the issue, and it's a massive red flag. Now, who is doing all this buying? It's not just your average investor. Governments are quietly accumulating silver, and they operate on a totally different level. See, retail reacts to price. We buy when it's low and sell when it's high. But governments react to risk. They don't chase short-term price movements. They secure long-term supply. Why? Because silver isn't just a precious metal. It's a critical strategic resource. It's essential for modern industry. Think about it. Every solar panel, every electric vehicle, every smartphone, and even advanced defense systems like guided missiles all rely on silver. It's the most conductive metal on the planet. As the world pushes towards green energy and high-tech manufacturing, the industrial demand for silver is set to explode. Governments know this. They aren't speculating on price. They're securing the raw materials needed to power their economies and maintain their technological edge. They are playing a long game, ensuring they have the physical metal no matter what the paper market says. So, if demand is rising and supply is shrinking, why isn't the price skyrocketing? This is the question that confuses most people, and the answer lies in how the price is set. The price you see on your screen is largely controlled by the futures market, the world of paper silver. Billions of ounces of paper silver are traded every day, dwarfing the amount of actual physical metal available. This massive paper market can suppress the price, even when real-world demand is stripping vaults bare. It's a system designed to manage price, not reflect physical reality. So silver shortages don't explode prices immediately, they build pressure. Imagine a dam holding back a massive reservoir of water. The pressure builds and builds behind the wall, but from the outside, the dam looks fine. That is, until a crack appears. That's what's happening now. The pressure of physical demand is building behind the wall of the paper price. When that wall finally breaks, the price won't just rise, it will surge. And history proves this isn't just a theory. Look back at past silver squeezes. They never start with a bang. Every major silver squeeze started quietly, then moved violently. Think about the Hunt brothers in the 1970s. For months, they were quietly accumulating physical silver and futures contracts. The market barely moved. Most people were completely unaware. Then, suddenly, the physical market seized up. There wasn't enough silver to deliver on all the paper promises, and the price went vertical. There's always a delay between the start of a physical shortage and the price explosion. The market ignores the fundamentals for as long as it can until it physically can't anymore. We are seeing a similar pattern emerge today, a silent drain on inventories that the broader market is choosing to ignore. But history tells us that once the tipping point is reached, the reaction is swift and dramatic. So if you can't trust the price, what should you be watching? Smart money, the institutional investors and informed insiders, they aren't looking at the daily price chart. They're watching the real-world signals. First, they track inventory levels at the major vaults. When those numbers consistently go down, it's a sign that demand is outstripping supply. Second, they watch for delivery delays. When it becomes harder and takes longer to get your hands on actual physical silver, it means the system is under strain. And third, and most importantly, they watch the premiums. Premiums are the amount you pay over the spot price to buy a physical coin or bar. When premiums rise but the spot price doesn't, something is wrong. It means buyers are willing to pay extra just to secure the physical metal, a clear sign of a tightening market. These are the signals that precede a major move. Silver doesn't disappear overnight. It vanishes slowly, then shocks fast. If you're only watching price, you're already late. This isn't just about another investment. It's about understanding the deep currents moving beneath the surface of the global economy. The clues are there if you know where to look. Subscribe if you want signals before headlines, not after.